So if we wind back the clock all the way back to the 1980s, I wasn't managing money then, but it would have been a relatively easy thing to do. Retiree could have taken their nest egg that they spent decades accumulating, walked down to the bank with money markets and low risk CDs paying between 12 to 16%. All a retiree had to do was simply just live off the interest. Flash forward to the 1990s, the next decade, I still wasn't managing money then, but it was only slightly more difficult. You could have taken $1 million in 1990, plopped it into the broad market, let's say the S&P 500, and the market did so well over that decade that you could have pulled $100,000 a year in income every single year. And at the end of that decade, so January 1st, 2000, you still had over $2 million saved up with pulling $100,000 every year. That's how well the market did. Flash forward to the 2000s. This decade was marked by a couple major market downturns. Early 2000s, we had the tech bubble burst, and obviously in 2008, 2009, we had the mortgage crisis. So maybe our chart looked something more like this, where adjusted for inflation, looking at, let's say, the S&P 500 again, you would have actually averaged a negative return over that same time period after you adjusted for inflation. So this is more so a great example, textbook example of why we don't want to have everything in just the S&P 500. Just looking at diversification alone, owning those different parts of the market, whether it's international, emerging markets, small cap, bond allocations, real estate, you would have done substantially better with less risk over that same decade. Moreover, to the same point, this is why we don't want to just measure our progress or our performance every year by just the S&P 500. A lot of analysts out there call this the lost decade for this reason in United States investing. 2010, this decade was the longest bull market run in history in the United States. And then the question becomes, where do we go from here? This is why it is more important than ever to have this disciplined approach in a retirement distribution strategy, so when you do stop working, we can replace that paycheck that you were accustomed to already when you previously were working, to ensure that your money outlives you rather than you outliving your money.